Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital. Today's topic is on equity rotation. Right, so we'd be thinking about the U.S. versus non-U.S., large versus smalls, value versus growth. Where should we be thinking about in terms of rotation? Right, those are the questions we want to answer today. Now we're going to be looking at earnings per share growth. All right, I want to start off, I want to make sure we're all singing from the same hymn sheet here, folks. And to do that, first, earnings per share, two caveats or two things that are important. One, for the last 4 or 5 years, the stock buybacks have been reducing the number of shares outstanding. And that gives rise to earnings per share growth synthetically, right? Earnings aren't growing, it's a per share number that's been coming down. Keep that in mind. We don't have that anymore. We're not going to get the push of EPS expansion due to stock buybacks. All right, the second thing is when we look at earnings per share, it doesn't tell us anything about price, right? If the earnings growth is already fully priced in, well then what? Well, that's a fair point. Now what I would say is during earnings up cycles, right? During economic up cycles, generally the market doesn't care about things like price versus price to earnings ratios. In up cycles, the market tends not to care. They worry about it in down cycles. Well, the regular viewers are going to say, hell, fat man, you tell us every other day that we're in an earnings down cycle. And it's true. That is true. But the market psychology is not in an earnings down cycle. We're not there yet, right? Look, every pullback is a buying opportunity as far as the investment public is concerned. That is upcycle mentality. So even though the world around us is in a down cycle, psychologically we're still acting as if we're in an up cycle. So I'm going to just focus on earnings growth and leave the price considerations to another discussion. All right, so let's get into this. Earnings growth. All right, first of this chart here, you know, again, it's EPS that's expected over the next year. And we have our two orange blocks here, the two major U.S. indices, okay? And then the light green are the U.S. indices that are not the top two, all right? So we got value growth, smalls, and so forth. And then dark green is everything else, right? That's how we want to read this. Okay, so what do we see on this chart? At the top of this chart, China, NASDAQ, and India top the chart. Wow. All right, they have been outperforming. We would expect them to continue to outperform. In other words, the recent run-up in Chinese equities is at least partially legitimate, right? There's a fundamental reason for the rally. And of course, we know tech. The NASDAQ heavy tech, the tech earnings, the robustness there, the quality of the balance sheets, it's coming through, right? It looks good. But let's go back here and take a look. Again, I want to look at here at the difference in the two orange bars. NASDAQ's growing 12% per year in earnings, while the S&P is falling 12%. That's amazing. Wow. No wonder the NASDAQ has been outperforming the S&P 500 by so much. Night and day between those two. Now, also think about the overlap between the firms in the NASDAQ that are also in the S&P 500. The mega cap tech names. If we were to pull those out of the S&P and look at the S&P in isolation of those mega caps, this thing would be falling a lot more than 12% here. So this gets us to our first observation here. Notice the location of the S&P 500 in terms of the ranking. For the last few years, the S&P has been on the top. It continues to melt, folks. Look at Europe's on top. EFI, which is Europe, Asia, and the Far East. It's a developed market index that doesn't include the U.S. Right? Brazil's here, Japan's here, and we already talked about the other ones. Where am I going with all this? What's the fat man screaming about? We're probably looking at a rotation out of the U.S. All right. So if we put the two pieces of information together that we've established so far, tech works. There's a reason tech has been outperforming. I would continue to ride that horse. But your non-tech exposure in the U.S., you might want to think about moving it out. Right? Moving it out. If you want to stay in developed market space, you want to consider EFI. right? If you want to go in the emerging market space, China and India seem to be attractive bets as far as that goes. Now, part of this rotation, this change of leadership, and again, this is change of leadership we haven't seen for 3+ years. The U.S., the S&P 500 has been leading everything. But this change of leadership we're talking about is probably going to happen slowly over the next year, right? Particularly over the next 9 to 12 months to really pick this thing up, right? For this thing to catch fire, we're going to need the currency markets to help us, right? We're going to need some dollar weakness to make those foreign equities for U.S. investors, right? U.S. investors holding foreign equities are going to get a twofer. They're going to win on the currency, and they're going to win on the foreign equities. And when that happens, of course, then the change of leadership is just going to be boom, right? A pop in your face. All right, let's go on. What else do we have in this chart here? If we look at the light green bars here, we got growth versus value. Growth is expected to fall 2.6%. Value is expected to fall nearly 20%. One's falling 2%, one's falling 20%. I don't need Kim Kardashian to help me with this one, folks. Stick with value. Stick with growth. Maybe I do need Kim Kardashian. Now, why is that? The value versus growth is at all-time highs. I know that, right? And it's popular to start talking about how value is going to make a resurgence. Bullshit, folks. Bullshit. Right? I understand the popularity. I understand the charts, but you got to be smarter than the charts. You have to be smarter than the charts. What's the fat guy talking about here? If you look at the composition of the growth index compared to value, it is overweight tech and it's underweight financials. It's almost mathematically impossible that tech can stay in favor while value starts to beat growth. That is almost a mathematical fact. So stick with growth. Stick with growth. Now, the way I would explain this is if you think back to the Industrial Revolution. Now, do you think there was a time right during or after the Industrial Revolution where industrial stocks outperformed like never before? Well, shit, yes, they did. I wasn't alive back then, regardless of what my kids might think, but I'm almost sure they did. They outperformed like never before because we were going from an agricultural-based society to an industrial-based society. Boys and girls, we are in a tech revolution today. We are a tech-based society today. So the fact that growth is outperforming like never before, like tech is outperforming like never before, it's because of a structural shift in our society. That's all there is to it. All right, let's go to the last one here. Mids, the bottom of the chart here, we have smalls and mids. So while the S&P is expected to fall 12%, mids are expected to fall 26%, smalls are expected to fall nearly 30%. Again, I don't need one of the Kardashian sisters to help me with this one. Stick with the large caps, folks. Stick with the large caps. I know they've been outperforming. I know you want to run back to smalls. Now's not the time. Now's not the time. Okay, very quickly, let's look at this next chart here on a sector basis. Again, we have the S&P falling 12%. I generally like to identify things that are outperforming the S&P in general and those that are underperforming. Those that are underperforming, right? You want to try to catch a falling knife? Energy's your place. Of course, you're running against the greener trend. You're running against 500 different $40 oil and so forth. You're running against everything. But if you want to try to catch a falling knife down here in energy, you want to stick with the safe bets. They're up here on the top, right? Stick with earnings growth. All right, that should come as no surprise. That's no surprise. Two quick other notes, things I want to note here. One is we got a shift coming up, a compositional shift, and there's two of them. One, China's going to change the formula, the calculation formula for its index. It's going to become more tech-oriented. All right, it's going to become more like the U.S., and that partially explains the run-up that we're seeing in Chinese equities right now. That happens on July 22nd. Keep that in mind. The other thing is Tesla. And I know Tesla is a popular stock, but ladies and gentlemen, I do not like this company. Sam, I do not like this company. However, I do like mathematics. And Tesla is most likely going to be picked up by the S&P 500 very shortly. And when the S&P picks it up, then of course all the ETFs, all the passive funds, they have to pick up Tesla as well. So I may not like it, but there's sure going to be a whole hell of a lot of people that are forced to buy this thing. And that probably explains the run-up as well. So again, those are some things to consider. The rotation, again, stick with what's working within the U.S., but think about rotating out. And also consider these compositional changes. All right, that's our message for today. I'm Don Rich, and you just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.